Thank you for being here. It's good to do these. I haven't given these talks in a couple of years now. We did one last Monday. I've probably given over 500 of these maybe over my career, which is a long time. Started in 1995. So it's fun to do them. I told my wife we're going to do them. We'll talk about what I want to talk about, right? And so just think of tonight as a conversation. I've been doing this, like I said, for more than half my life now. So, I got something to say. You might agree, not disagree, but I've been in the line of fire for a long time. And so our tagline's not by accident. You retire once, we retire every day. We've retired hundreds and hundreds of times, right? And it's a big step going from accumulating assets to distributing assets. The biggest fear people have is running out of money, and also they don't want to spend their money. It's kind of a circular problem, right? Usually it's one spouse, honey, I don't want to spend the money, and the other one's, hey, I want to just go have every trip I can get on. But I appreciate you being here. We're only going to probably do these maybe once or twice a year. I don't know. As long as I enjoy doing them. Again, most of our clients come from referrals from our existing clients. I've been doing radio. I've been on Kogo for over 20 years now. Back, I think in 2002 is when I started. And then we started during COVID. We got asked to do television because everybody was home, right? And so CBS, who actually used to own one of the stations we were on, was a local family, not anymore, but they used to. They got bought by a big company, asked to do television. So we started doing some TV, and that's been great. I love to teach, and it's the main thing that we do is educate people about their retirement and about planning. And I've just found that there's a lot of things that I think, our industry as a whole. Is that me? No? Okay, I hear something. I think our industry as a whole does a really poor job of really managing money and secondarily doing planning. A lot of companies will take your money and manage your money for you, but very few, I think, will do the works required, especially when you start distributing money, right? So most of you are here. How many people are already retired right now? So more than half. That's about, how many have not retired yet? That's about right. So probably 60% are retired. And that's about, people always ask me, David, so, am I too late? I get that all the time, right? I'm sure some of you are thinking here. No, you're here, right? You're in my office or wherever you're at. I would say the majority of our clients that come visit us are already retired. It's probably about this room. It's probably 60, 70% are already retired. So it's never too late. And then congratulations. If you're not retired, you're seeking this kind of advice. I think it's important. But tonight, again, I mean, of course I prepare for these things, but it's really just a conversation. I'm just going to give you my experiences that I talk to clients with every day. So everything we talk about is real life. It's not a pie in the sky. Everything I discuss, we do. You listen to me on the radio. I'm on every Sunday. We're on Saturdays now. I've talked about the same things for 30 years, right? And they work. When you start with, I call it begin with the end in mind. Anybody ever read 7 Habits of Highly Effective People by Stephen Covey? No? Nobody? Yeah, one? Yeah, there you go. Yeah. I read that book when I was 23. And I love that book. And it's one of the most famous books ever, probably one of the most popular books in the world. And one of the habits was begin with the end in mind. And he talks about your eulogy, right? It's kind of more of a kind of not, but I think of that with planning. The end in mind is I'm going to stop my job and I don't have a paycheck anymore, right? So how do I reverse engineer my finances to figure out what kind of lifestyle that I can have? And so kind of going through some of the bullet points up here, just talking about some of these things. Of course, you're here because you're retired or you may want to retire soon. Most people in this room do not have a formal retirement income plan. I see hundreds of clients a year, and I can count on one hand per year, maybe less than one finger. How many clients come to see me that have a written retirement income plan? Like, it just doesn't happen. On two hands, I can't count the amount of times in my whole career. So I'm being very generous. Every one of our clients has a written retirement income plan. We call it a retirement blueprint. So, because, if you're going to stand behind what you're going to do, you better put it right. And these are things our staff does. It's not some word processor, not some program. It's what we do. I have books I've written. Our spreadsheets are in the books I've written 10 years ago. And so every one of our clients has a full-blown retirement income plan. So unless you have an income plan, how do you know how you need to manage your money? How do you know how much you can spend? Most firms use, anybody know what a Monte Carlo simulation is? Yes? Monte Carlo simulation. It's a very fancy word for random number distribution. It was basically based upon nuclear fallout from a nuclear weapon. And the scientists of Monte Carlo did dispersion analysis. And that's what a Monte Carlo simulation is when you go to fidelity.com or Vanguard, all that is basically saying, oh, you're going to be fine. You have an 87% chance of not running out of money. Great. Here's the problem. It's meaningless. It's wallpaper. I know wallpaper's not in style anymore, but it's basically wallpaper in the sense that it's kind of like, think of it this way. Let's say you have to walk through a body of water that averages 4 feet deep. You're 4 feet deep and you're 5 feet tall. But during that mile stretch, half a mile in the middle is 20 feet deep. You're going to drown, right? That's basically what a Monte Carlo simulation is. We don't use them. We have to actually use actual cash flow. Think about that. I like to use the analogy of a rental property. How many people have rental properties in here? Right? Good. That's most of our clients. Okay. Is that a rental property is great because guess what? We have two sources of revenue or two sources of value, the value of the property and the cash flow. Most people in this room are just, when they go to retire, they're just going to sell assets called your 401k plan, right? It's like selling the third bedroom of your house. That's not cash flow. That's selling assets. That's a different. So most firms, that's what they do because that's just, okay, I hope the market goes up and I make income, right? So we want to create cash flow. So when I used to do these workshops a long time ago, I draw a house around your 401k because in a perfect world, I can create cash flow. I still have my house there, my 401k, and it can still grow. That's the ideal situation, right? And we're going to get very specific tonight about money management because in order to have a good plan, you have to have a retirement income plan, and you also have to have a really solid investment plan to execute that plan. Make sense? Right? We can't have, we'll talk about our second opinion process, which we do as complimentary offering to all of our prospective clients. And we give away, here you go, have it, right? The reality is it's not that it's meaningless, it's very important and you can use it for yourself, but unless you have the proper money management that's going to go behind that plan, it's not going to be as sound. So, again, we talked about running out of money. The biggest thing is I want people to enjoy their retirement. And right now, and it's always been this way, but people are overwhelmed. There's so many things going on in the world. And it always seems as we get older, I've been working with baby boomers my whole life. I'm right behind you guys that are in this room. And in the sense that, there's always seems to be problems, right? We live in the world it's it's a little chaotic. And so retirement plan on your own is difficult. How many people, well, I'm going to come back to this, but so it doesn't matter, if you're in this room, you've talked to my staff and this is a workshop that will be meaningful to you. But our average client is in probably, the 5 to 10 million range of total assets. Doesn't really matter. If you're here, that's good. But it depends. Do they own, 5 apartment buildings? Do they own a business? So we built the practice for our clients. And so we're going to deal very heavily with retirement income planning, tax planning, right? Real estate. We're going to talk about real estate a little bit tonight. I've got a lot of thoughts on that. We've been very involved in real estate as a firm, both on the tax side and investment side for many, many years. But basically, people fall into what I would call 2 different buckets. So how many in here have an advisor currently? 1, 2. How many have an advisor? 1, 2, 3. 3. Yeah, that's funny. So the last group I talked to was last Monday. It was about the same. It's funny. That's low. It's low. The good thing is that both sides have their pros and cons. My recommendation to you, this is like a PSA right now, is I would hire an advisor, right? I'm not being self-serving. I'm telling you, hire a good advisor that understands taxes, retirement distribution planning, high-level money management, risk management. Basically, we're a risk management firm and a cash flow firm. Basically, what we do is manage risk and produce income. That's what we do every day, right? The reality is that most of you in here with your assets that you have, especially if you're doing it yourself or even you have an advisor, there's no risk management happening. I'm telling you. I analyze portfolios every day. It's basically set it and forget it. It's this 60-40. I call it the boomer portfolio. Okay, whoops. Go back. I call it the boomer portfolio on my radio show, right? Why? Because I can close my eyes. Somebody 65 walks into my office and I can pretty much tell you what they own. Not exactly the funds or stocks they own, but basically they're about 60% stock, 40% bonds. Okay? They've owned target date funds their whole life, right? Through 401k plans, which is basically all there is, which is all a target date fund is doing is buying more bonds every year. That may or may not be a good thing. We're going to talk a lot about bonds today. So in the world we're in today, a 60-40 portfolio is broken. Bonds should not be 40% of your portfolio. Period. End of story. right? Inflation, which we'll talk a lot about, inflation, which was a big problem during 2022 when we had the Federal Reserve raising interest rates. We had inflation that was happening. We had the war in Ukraine that's still going on today. And inflation was double digits, right? I'll remember that. And inflation is really, if you look at true inflation, which I look at, which is actual like real-time inflation, is about 2.5% right now. So inflation's actually fallen quite a bit, but it doesn't feel like that because we don't have deflation. Prices are still rising, right? So the reality is that bonds, we're going to talk about bonds in a minute. Bonds are like a giant anchor around your portfolio. Okay. We're going to get into very specifics about this. And again, I'm agnostic. All I care about is you. I don't have Morgan Stanley or somebody telling me how to manage your money, because believe me, they do. Lots of conflicts of interest with the big banks. I would stay away from big institutions. If you're going to hire an advisor, hire an independent advisor that's a fiduciary, period of the story. Because at least they're going to be free to manage your money the way they see fit. Doesn't have to do it my way, do it your way. Hopefully you're happy with them, but I would stay away from the big institutions. And so we're going to dive deep into what I call the buy and hope portfolio, what I call the boomer portfolio, and why I believe it's broken. So the difference with what we do, which these are not just saying, oh, we're different. No, we're different in the sense that the first thing we care about, we have a saying, we want the most amount of income, least amount of risk, never run out of money. Okay. Most amount of income, least amount of risk, never run out of money. The biggest first thing we do is have to manage risk. You're coming to us with your entire life savings. You have more money in your bank account, in your 401k plan, your IRA, in your home than you ever had in your whole life. Is that probably an accurate statement? Right this very minute. Every one of my clients is the same thing. So we're managing their entire net worth. That's a serious endeavor. We take that dead serious. Dead serious. Probably more than you do, just because we're doing this every day, right? You're out having fun. Go play, right? I think the biggest advantage of hiring an advisor, a really good advisor, a fiduciary, tax experts, retirement planning experts, good at money management, is just the freedom to do what you want to do. Because a lot of people that, I've got, how many are engineers in here? Probably about 20-30% of my clients are engineers. Okay. And that's not by accident. My dad actually worked for NASA when he was young. He helped build the Astrodome, from Houston. But my point is, so I'm half, engineer, half camp counselor, mostly camp counselor now, right? Because all I'm really doing is advising people in really a relationship. You have a money relationship. I call it the mistress, right? We all have our own relationship with money. So the reality is that if you're the person that's doing it yourself, which God bless you are, I think it's difficult. I think it's impossible to optimize your retirement by yourself. It's just not possible. It just isn't. You can probably muddle through and be okay, but part of it's the peace of mind. Part of it is the freedom to feel secure about your retirement. Part of it is the number one reason clients hire us, besides the planning and the money management, is what if something happens to my spouse? That's the second or third reason. The first reason, meaning there's one of you in this room, not being sexist, but it's probably the man. My wife runs the financial, she's a CPA in our house, right? I say, honey, how much money do you have? Okay, good. She does all, I can't take any credit for that. But what happens if you're the spouse in here that's in charge of the finances and you pass away? Is your other spouse going to be able to handle those finances? That's a big deal. It's a big issue. 20% of my clients are single women, and not because of divorce. Okay. So I was raised by my mother and my grandmother growing up. So I was raised, almost everybody in my office is women, except for one, Eric. We're the token males in the office. But, so the fact is that I think doing it yourself is a very, very treacherous endeavor. And I think it's unnecessary, right? So if it's us or somebody else, I would go through the process, which you're here. It's probably not your first workshop you've been to, but I would go through that process with a couple of different advisory firms. See who's a fit or not. You're going to learn stuff anyway. If you go through our second opinion process, I guarantee nobody's ever complained about that. Everybody loves it. Doesn't mean everybody hires us that goes through that process. The majority of people do. But the reality is, it doesn't make a difference to me. If you're motivated to come see us, we'll get into this at the end. I'm motivated to help you. Okay. So again, everybody gets a full written retirement income plan. We're going to get into money management more deeply than I ever have in any other workshop. Because for some people, they just don't care, but I'm telling you, it's important, right? Most people get bored by this stuff, right? And so I told my wife, I'm going to do this. I'm going to talk about what I want to talk about, what I think is really, really important today. So we're going to touch on the one big, beautiful bill. I think that overarching, there's not a lot of stuff in it for most of you in this room, unless you're a business owner in real estate. If you're acquiring real estate or businesses, or, or you're depreciating a business, or capital expenditures. There's lots of things in there for you. Okay, what's called Section 179 deductions, which you can accelerate depreciation, other things 100%. But most anybody business owners in this room? Yep, this guy. Okay, yeah, good. So again, I'm going to talk about the One Big Beautiful Bill just in a couple different areas, but the main thing to take away from it, which gets overlooked, is the tax rates got locked in. That's a big deal, meaning that the tax rates the way they are today, that's the law, right? That was a big deal because these are going back to the Tax and Job Act from 2017 that are now made permanent, right? I'm not here. It's not a political show, but if another person got elected, the tax would be higher, right? So whatever you think about that, I'm just telling you the one thing to take away from the One Big Beautiful Bill is the tax rates are permanent. That's important. So I want you to think about that and know that's the biggest thing from the bill.
Say that. What do you mean by tax rates are permanent?
Meaning that the tax rates were going to jump up. Yes, the brackets are permanent. Thank you. Yes, the brackets are permanent. They were going to revert back to the old brackets, which were higher. Okay. So I just want to leave you with that on that part of it, knowing that is the biggest takeaway from it. There's other things, one is the senior tax deduction, which was what Trump was talking about as far as the, no tax on Social Security, right? So basically what he ended up getting through was the senior tax deduction, which is $6,000 as a single person, $12,000 as a married couple, up to $150,000. So that is one. So that's real. So the average person that's from retirement is going to be in about a 20% effective tax rate. Does anybody know what an effective tax rate is? Yeah, it's not in his head. Basically, what an effective tax rate is basically just taking all the brackets, state and federal, add them together, and here's what you're paying as a percentage of your gross income. So if you're making $100,000 a year and you're paying $20,000 a year in taxes, your effective tax rate is 20%, right? So blindfolded, without looking at your tax return, I can tell you the average person in this room would save based upon the senior tax credit. If you qualify, it's between 15 to 20%, because even most of this room are probably not going to be in the 20% bracket, to be honest with you. Taxes are overstated in retirement, meaning tax burdens are not as high as when you're working. Okay. And I deal with a lot of clients that are in the 50% bracket, right? So the average person, the couple in this room is going to be between 15 and 20% effective tax rate. That's not your biggest problem. It's not your biggest issue. But theoretically, if you're in a 20% bracket at $12,000 deduction, that just saved you how much? $2,400, right? $2,400. That's real money.
Another question.
Yes, ma'am.
What if your AGI is over 75?
Then there's phase outs, or you don't qualify. Yep. So part of the planning, this is all new, right? Remember, we're dealing with this now. This is for next year. So a good question. Thank you. Is that you're going to have to be a little more sophisticated things like Roth conversions, right? People don't want to do that. Now, most people don't do a lot of Roth conversions, to be honest with you. And we do them, we do them very aggressively when they're no brainer. We don't do them just to do them, right? They have to make a lot of sense because you're paying taxes today for future benefit. So if you have kids, and you have a lot of retirement assets and you're probably going to leave a lot of money, then maybe we do Roth conversions above and beyond everything else for the kids, grandkids, right? But I'm not here to talk about Roth conversions today. But answering back on your question is that what's going to happen is part of our job going forward with our CPAs is going to be managing brackets for cash flow and where's money coming from, right? Meaning that how much money is coming from IRAs versus taxable accounts, because we want to manage that going forward. That's actually a very good question. So for us as a firm, we work very closely with our CPAs that work with our clients directly. Those are something that we'll manage to make sure that we're trying to do everything we can to qualify for those deductions. So the SALT deduction, what the SALT deduction is? State and local income tax, right? This is basically itemized deductions. Okay. Now the standard deduction for married, I think in 2025 is going to be $31,700. So now, and I'm using married filing jointly just as an example. Now it's going from $10,000. So like mortgage interest, those kind of things, DMV fees, taxes, we can write those off up to $40,000. So now this next year, you have to look at the difference between a standard deduction, which most of you in here claim anyway, or you have because it's high. It's 30, again, for a married filing joint, it's $31,750. For married, for the SALT deduction, the state and local tax, where you can itemize, it's $40,000. So the difference is only less than $9,000. Meaning that not everybody is going to benefit from that, but $9,000 if you're in a 20% bracket, let's do the math, what's 20% of 9 is $1,800, right? So let's say theoretically you qualify for the SALT deduction, the itemized deduction. You qualified for the senior tax benefit. You're talking for $4,500 of tax savings between those two. Okay. So it starts adding up, gets significant. These are the two major areas, though, is the SALT deduction and the senior tax credit. The other thing that got locked into was also the estate tax. So most of you in this room, we do have clients. We have basically two divisions of our company. We have our traditional clients, which is probably most of you in the room here. I would say in the $5 to $10 million range of total assets. And then we have our clients that are ultra high net worth that are 40, 50 million and above. And we do deal with those kind of clients, right? The benefit that you get from that is we deal with very sophisticated tax planning around that. So a lot of you in real estate in this room, we're going to get into a whole section just for a quick example of what we're doing with people that want to dispose of real estate and how to mitigate taxes without doing exchanges. We'll discuss that tonight. But you get the benefit of us dealing with these more sophisticated clients that we have tax attorneys we deal with, high-level estate plan attorneys. So when there is a business sale, when there is a real estate sale or something of significance, and I'll show you an example, we can have big impact. Okay. But with the estate tax side, now it's $15,000 per person. So it's $30,000 married filing jointly. So most people don't even have that. That's not going to benefit them, but at least it's an opportunity to revisit. And maybe there's some planning we can do to make sure we're taking advantage of these things if there are issues with that. But I wanted to bring that up because that is part of the One Big Beautiful Bill. So we always want to turn policy into planning. And basically, this is just what we do. We're going to look at really two areas in particular. Tax is a big part of our practice. Again, my partner's a CPA. We're very closely with our CPAs. Probably half of our clients use our CPAs. And so that clients like that, right? I'm on the phone every week, or our staff is with our CPAs about a client. And it's usually something significant. We got clients right now selling property in Hawaii. We're helping them. We're going to save them, I don't know, a couple $100,000 of tax on that particular transaction. And so we're really, really, really involved, right? I built the firm for you. My clients own real estate. They have retirement accounts. You should be an expert in real estate. Would you not agree? If you do my job, you should know a lot about real estate. Is that fair? Most firms can't even advise you on tax or real estate. They're not allowed to, or estate planning. That's crazy. How can they be an advisor to you? These things all matter. Planning not only has to be implemented, it has to be integrated. We have to look at everything from a big picture. My gift that God gave me is I'm a big picture. I can see all the stuff. Right? Like I can't even give you advice till I see everything. No, okay, here we go. There's how I see it. Right? And so unfortunately, most of us are kind of, the CPA has an opinion here. The attorney has an opinion here. We have to see things on a bigger picture level. So we want to mitigate the taxes, as this young lady was talking about, relative to there's some opportunities going forward to make sure that we're managing tax brackets. Is it smart to do a Roth conversion? Whoops, we do a Roth conversion. Now we're paying more tax over here because we're now outside the brackets for the senior tax deduction. Revisit the estate plan. And most importantly, I would say of everything is the comprehensive retirement income plan that's going to take advantage of all of these things. What do the taxes look like? What do the investments look like? What's the cash flow, right? What's the cash flow? The first question that I ask, and we'll get into this in a later example, is how much money you're earning today, right? So that's the simplest way. If you're netting $10,000 a month in net income after taxes, FICA, 401k, all that, right? Because it's not your gross income, it's your net income. Most of you are saving, if you're still working, a lot of money in your retirement accounts. How much is being deposited in your paycheck? That's the first place we start. If you're retired, you have a better idea. So how do we optimize that? How do we mitigate more risk? How do we give you more income, right? Those are the kind of conversations that we're going to have. So this is where we start going to get it. We're going to get into, I'm going to play a quick video for you. I did this about 2 years ago, I think, a little less than 2 years ago, because the good analogy, we're in Great San Diego, and you'll see it. It's an analogy using rowing and sailing as an analogy for managing money. So I want you to listen to a couple minutes of it.
There you go, Blue Shirt. Along the winding path, dreams fulfilled and goals achieved. But along this journey, many individuals, much like yourself, encounter some common questions. Is your financial plan steer you to a desired destination? Will your investments propel you to your financial goals? Or is it time to reevaluate your financial strategy, ensuring that your nest egg is secure when you need it most? We firmly believe that a well-balanced combination of financial strategies can help you stay the course. An experienced guide can assist you in managing risk, mitigating potential losses, and planning for any twists and turns of life may throw your way. Think of it as having a seasoned navigator on your journey, making the entire trip more enjoyable and less stressful. At this stage of life, you've likely come to a similar realization that we have. The financial market is far from predictable. There are times of long bullish markets characterized by steady growth. Let's call these sailing markets. Conversely, there are long stretches of bearish markets, often marked by extended declines or extreme volatility. These are our rowing markets. These periods can extend over several years, a decade, or even more. And just when you think you've got a handle on things, the market can throw you a curveball, like a sailing market in the midst of a long-term rowing market, or the sudden rowing in a sailing market. These market reversals can be unsettling, even for seasoned professionals, determining whether they signal the start of a new long-term trend or are merely temporary ripples in the market's overall direction can be a significant challenge. Each market, whether it's a sailing or rowing one, presents unique opportunities and challenges. However, with the right strategies in place, you can navigate these waters effectively. But even with careful preparation, volatility and sharp fluctuations can take a toll on your confidence. Recovery from a low point can be much more challenging, both emotionally and mathematically, compared to recovery from a high point. This brings me to another critical question. How do you protect your investments during rowing markets while retaining the flexibility to seize opportunities when sailing markets return? Unless you're new to investing, you are probably familiar with the concept of diversification. For years, astute investors have used diversification as a strategy to grow and safeguard their assets during market volatility. Traditional diversification involved blending various types of stocks and bonds. However, the world has evolved and market volatility has intensified. This is why we advocate for a deeper level of diversification. We employ a range of approaches to asset allocation, carefully tailored to your life stage and specific financial objectives. Some strategies are tailored for sailing markets, enabling you to capture growth during periods of market upswings. Conversely, other strategies are designed for rowing markets, focusing on risk management to help them navigate turbulent waters effectively. This diversified blend of approaches aims to potentially reduce volatility in your portfolio while allowing you to adapt to a variety of market conditions. Nevertheless, a well-rounded portfolio that combines both sailing and rowing strategies offers the potential to capitalize on market opportunities, the flexibility to limit losses during market downturns, and the confidence to stay the course no matter what lies ahead. This alone could transform your financial journey into something you eagerly anticipate. Thank you for investing some time with us. If you'd like to delve deeper into our strategies for safeguarding your wealth, we'd be delighted to speak with you. Your financial journey deserves the best guidance, and we're here to provide it. Contact us today at reyesplan.com and let us help you create the financial journey you deserve.
So, I didn't come up with sailing and rowing. I stole it from colleagues of mine like 25 years ago. It was a concept that the analogy I like. So I can't take full credit for it. But again, we're in great, beautiful city of San Diego, and I've got clients that sail. And so I said, I'm going to start using that a few years back. So basically, think about it, right? Most of you in this room, your portfolios are only set up when things are doing really well. Is that fair to say, right? Because we panic when things aren't going so well, right? And most people, and including individuals that do it themselves and or the advisors, are doing nothing. Here's a dirty little secret on Wall Street, I call it. Once you fill out, for the people that have advisors in this room, I think there's a couple of those over here, is that once you fill out your risk tolerance questionnaire, which you're doing it yourself, you got your own risk tolerance questionnaire you're filling out, which is between your ears. But let's say that's a 60-40, 70-30, 80-20, whatever it is, that's never, ever going to change. It doesn't matter if it's World War III, your portfolio is going to be the same. Meaning that if you're a moderate investor and you're 70% stock, 30% bonds, that will never change. It just won't, which doesn't make any sense, right? But that's kind of a CYA of our industry because you said that's what your risk was. Now, it doesn't mean they're not going to buy and sell within that model of stocks and bonds, but they're never going to have you go to 30% stock because the market's bad. It doesn't work that way, believe it or not. And you most likely are not managing your money that way anyway. You're just going to white knuckle it and hope things come back and do that. I've been around long enough. I went through 2008. I went through 2000. So did you, but not retired. I have been with clients that retired. Big difference. I had people coming to me, not my clients, thank God, prospective clients crying on my table. I had 1 week, I had 5 couples crying on my table during the 2008 financial crisis. Lost everything, home, job, rental property, half their 401k was gone. So I always do the analogy, it's like being a trauma surgeon in the hospital, right? Yeah, I've seen people die on the table. You haven't. So ignorance is bliss. So we go, everything's going to be fine. Don't worry about it, right? And I'm kind of picking on you and really more our advisory community because it's just too apathetic. It's too passive, right? And so the reality is the way we're going to manage money in our firm, we're going to take a deep dive, right? And again, I've never given presentations like this before into money management because I think it's very critical for lots of reasons. But I'm going to get to a part on kind of philosophically what I think of. But right now, way we think of money management, and it's pretty sophisticated the way we do it. It's kind of risk on, risk off. What that means, the risk on is markets are good, things are good, economy's doing good, whatever that feels good, risk is on. Now we have things that we use to determine that, but markets are the last 6 months has been a risk on market. The markets are up 35% since the lows of earlier in the year. Meanwhile, they dropped 20% in 8 weeks, right? That was kind of a rowing market. So sailing markets are going to be, we own a lot of stock, we own other high yielding investments, we own real estate, things like that. A risk off market, think of 2008. It's a pretty simple one, right? 2008 was not good. That's risk off. Treasuries, gold, utilities, healthcare, consumer staples. Think of boring companies, right? Not Nvidia, not Broadcom, not Qualcomm, not these high flying stocks. So we as a firm, because we're a risk manager first. Remember I told you that we manage risk first. Believe it or not, we're the only firm I'm aware of in San Diego that even does that, which is crazy because most firms are just going to manage to the asset allocation that you chose from the beginning. That's it, end of story. And that's just a fact, period. Ask your advisor if you have one about that. They're not going to change the allocation because the market just have changed. It's not going to happen. And you're probably not either. You're probably going to hang on and hope things get better. So this is a good example, just going like the last, 6 years, 19 to 25. So let's just give you different examples of, we had 2020, the COVID crash. The market was down 33% in 3 weeks. That wasn't very good, right? That was pretty bad. And then, of course, here's the sailing market. The market was up for a couple of years in a row, did really well. Then we got into 2022. We talked about 2022. What happened in 2022? With the Federal Reserve raised interest rates, we had the war in Ukraine. Then we were in another sailing market again here in 2023 forward. Basically, the bottom was October 2022. Market's been rallying ever since, except for the nice little 20% correction due to the Trump tariff conversation that happened earlier this year. Okay? That would be called a rowing market in a sailing market, right? So risk management has to kick in, and then the market turned around. But the reality is we don't know. We're not that arrogant. We don't know if a 10% correction or 20% correction becomes a 50% correction. We're going to get into some examples of how people do run out of money in a minute. But I'm just trying to give you an example of how we use the terminology to make it simple of rowing and sailing. Here's the kind of cool part. Right now, with our strategies, as of Friday, some of our portfolios went into rowing markets, right? On Friday, the NASDAQ lost 4%. The S&P lost almost 3%, right? Now, again, we have our own technology that we use for many, many years to measure this stuff, but we're looking to protect the inflection points, right? Not every 1%. We're trying to look at, so right now, part of our portfolios have made adjustments this last week because of it, right? And so, I'm just getting, it says October 10th, which was Friday. That's why that date's up there. So some of our portfolio, you're going to see we run multi-strategy portfolios. So some of our money actually is now in a risk-off portfolio, okay? So when you go underneath the hood, and this is another way we manage money. So we look at money, really, if you look at it, we're going to get into an example, really 3 different areas. We use multiple strategies. You have, in this room, most of you have one, which is I own some stocks and bonds, and it's passive. There's nothing active about it. There's no risk management to it. We're going to look at really 3 buckets of money. We want to own stock indices like the S&P 500. We want to own sectors of the market. Think of under the surface, right? There's 11 sectors in the S&P 500, right? You have consumer discretionary, energy, financials, healthcare, technology, all these other sectors underneath the market, right? So there's opportunities down there, and there's areas that we want to avoid. Most money is made or lost by just avoiding bad areas of the market. Like during the financial crisis, bank stocks were down 80%. 80. The S&P was down 50. during the technology crash in the 2000s, 2002, technology stocks were down 80%. The S&P was down 50. So there's lots of bad stuff happening. I had a client of mine come in to see me in this November of 2019. Had about $10 million. Very wealthy guy, had a property in San Francisco, really wealthy guy. But he's about 75 years old. And he came to see me in May of the next year. We know what that was. May of 2020, what was happening? COVID, right? So guess what he owned? He owned all the airlines, the cruise lines. He came back to me, had $5 million in his account. Yep. Warren Buffett lost lots of money. He sold all his airlines at the bottom, right? He hit it himself because he doesn't like unions, and airlines have unions. But I think I heard there's a flight attendant here somewhere. But anyway, the point being is that I'm talking about more opportunity, but the reality is there's not only opportunity, but there's also ways to mitigate risk in here. So basically you have the stock markets on the surface, and under the surface you have areas of the market, sectors of the market, energy, technology, utilities, healthcare, okay? And this is just what's called a chiclet chart, and just ranks all these. I'll show you a better example. Here's the simpler. Well, what I want to show you is kind of an example. So in 2020, let's go actually 2022 is an easier one. 2022, the S&P was down 20%. Anybody remember that? Well, like 3 years ago. S&P was down 20. The NASDAQ was down 32. Painful. NVIDIA was down 60%. That was a painful time. What was happening? Rates were rising. Inflation was going higher. And we had the war in Ukraine, right? So here's now the sectors of the market. Look what it did so well. Why did energy do so well? Energy was up 59%. The S&P was down 20. The NASDAQ was down 30. Why is that? Well, guess what? Oil prices were $130 a barrel, right? So most advisors, most clients are not taking advantage of opportunities within different parts of the underlying sectors of the market. So we actually have actively, our portfolios will do that. Okay, I'm going to show you an example, but a lot of it too is what to avoid as well. Then you look at 2024, which was this was a rowing market, very defensive for us as a firm. And then sector-wise, you want to be in energy, utilities, boring stuff, and opportunistically in energy because firms like Exxon were up 50%. Chevron were because they love high oil prices, right? But then you go to like a 2024, and which you kind of close your eyes in bullish markets or up markets or salient markets, you're going to have technology do really well, financials do really well. And this is an example of that, right? So you don't see energy or utilities on this map. Same thing, you go back to 2008. What's on the top? Healthcare, utilities, even though they lost a lot of money, right? The S&P was down 55%. So I'm just showing you an example of, again, kind of above the surface, which is the markets, below the surface, which is sectors of the market. And we want to take advantage of both. This is like, I love this chart. What this is showing you is this is just purely for teaching purposes. If we happen to pick, and we have a system that we've used for many years that we use to pick sectors in the markets on top of owning the big markets, is that if you picked every sector for the last 20 years perfectly, which is not possible, you'd be up 6,383% versus the S&P up, 689%, right? 10 times the return. Only reason I'm showing you this is that the opportunity that lies within subsectors of the market that are there for you to take advantage of, either and or to protect capital or opportunistically to make money. So I'm going to switch gears to this. I'm going to leave it on this before I go too far. When I was talking about how a 60-40 portfolio is basically, it's like 1.0 and we'd have like 5.0. And this is, I'm speaking to you as an advisor if you were sitting across the table from me, not as a person speaking to you at a workshop. That's what I wish we were just talking at each other face to face here. In the sense that this is what I would talk to you about if we were in person together, is that the reality is that the portfolios that are still the old school portfolios of the 60-40 portfolios are broken. The reason being is that the bond market, and I'll kind of give you a sneak preview here, the bond market over here, over the last 10 years, if you look at the aggregate bond market, it's up 20%. It's basically 1% per year. 1% per year. So think about that. The S&P is up about, probably over the last decade, about 13% a year, probably give or take. Bonds are up about 1% per year, right? Inflation is only running less than 3% right now, but the reality is that we measure inflation with new magic numbers. If we used inflation like we did and measured like we did with the Bureau of Statistics in the 1980s and 90s, you'd be 4 to 7% higher. Meaning that inflation is running at 4, in the 1990s, you'd be around 7. That's just what it would be. But we've changed the numbers, right? Like our government does. If we were to use the 80s, you'd be at about 14%. Okay? That's about a 7 to 10% delta from what actual CPI is. Now, why do they do that? Where do you think federal pensions get raises from? CPI, right? So a lot of measurements so there's a reason for this. So really inflation is running probably mid to high single digits. It just is. And it feels that way anyway, right? It just is. So the reality is that one of my mentors and one of the persons I've listened to many years, he calls bonds a certificate of confiscation, right? Because it's the only guaranteed way to get paid less than the rate of inflation, right? If you believe what I'm telling you, and inflation's running, high single digits, and you're getting paid 3 or 4% on your bonds, it's a guaranteed loss of purchasing power. Would you agree with that? It just is. It's not possible for bond yields or CD rates or money market rates to outpace inflation. It's not the way it works. So I look at it using the Rowan and Saley analogy. Bonds are a giant anchor around your portfolio. They just are. Opportunity cost. Inflation is the problem. We want to own inflation, right? So what's happening right now, I look at things from what's called a macroeconomic level. And that just means, what are happening with interest rates, inflation, the economy, the dollar, currencies, these types of things that we actually pay a lot of attention to. So what's been happening, this is now people always complain about the dollar. David, the dollar has been crashing for many years. It has. Depending on who you believe, it's probably going down between 3 to 5 to 8% per year. Okay, as far as the value of your dollar, what it used to buy per year. And so what's happened is, on top of that, we have a couple of issues. A, we have a $38 trillion deficit. We're running $2 trillion deficits. We have now kind of almost a currency war, a reserve currency war now with China. Okay, so what's happening is China, India, Brazil, all these countries are buying gold hand over fist. The reason being is that they are trying to compete with the United States, what used to be called the petrodollar, back in the 70s, because everything is pegged to the dollar. And that's what's led us to have the great life that we have. Most emerging market countries don't have what we have. And part of it's just the reserve currency. And so what's happening now, because there's this angst, and it's kind of a financial war with China, India, Brazil. India's kind of jumped on the side a little bit of China. Russia, of course, is that now their gold is being purchased a lot, so they can now have their own reserve currency backed by gold. That's just what's going on right now. And I'm only bringing this up to you because I'm going to show you some slides that'll hopefully shock you in a good way. Is that, would I rather own something that's going to be inflationary when we have inflation, or own something that's going to be disinflationary or going to guarantee I lose purchasing power like bonds, right? Now, the only thing, when we own bonds, we might own U.S. Treasury bonds, short-term Treasury bonds as a placeholder, but it's not an investment, right? Like if you're a new client of mine, we're bringing money over and we're deciding how we're going to do. I'm going to park you in short-term Treasury bills. You're going to earn 4% right now. It's probably going to be 3% by the next year. Okay, rates are going to come down. They're already coming down. CD rates were paying 5%, a year ago. Now you're lucky to probably get 4%. I think the average CD rate I just read the other day was 1.5% nationally. But the reality is, the reason I'm sharing this with you, federal deficits, budget deficits, currency wars, China. The reality is this is seriously impacting the value of the U.S. dollar and in fact, impacting commodity prices. Okay, and commodities are a missing element to most clients' portfolios. They just are. Less than 1% of clients' portfolios own gold or any commodity. Okay, go look at your own portfolio, right? So we look at portfolio. So I'm giving you kind of the why, because all I care about is something that's going higher, right? We want to avoid things that are going down. We're not going to be perfect, but the point is, I call it the physics class, right? An object in motion, what? Stays in motion, right? We want something going this way, right? Again, going back to sector rotation strategy that we run, thinking about commodities and from a macro perspective, and from a risk management perspective for inflation. So commodities are going to become a big part of our portfolios the last couple of years, really since the war in Ukraine. Okay, that's when we really started paying a lot more attention to the commodity side, because commodities can be very volatile, there's no question, but we're actively managing commodities. Okay, so I'm just going to give you an example. So this is bonds versus gold, right? So what I'm telling you is that gold for sure has a much more meaningful portfolio part of your portfolio today than it ever has been. I think so. The last 10 years, gold's up 233% versus bonds up 20. And that's what AGG, aggregate bonds, that means like short-term treasuries, corporate bonds is an aggregate. What Vanguard, they have a ticker called BND. It's just what our industry uses for a bond portfolio, which is a blend of corporate bonds, treasury bonds, those types of things. So this is a real number. It's ridiculous, right? I think this year, I mean, right now, I think gold's up like 45%, silver's up 50, rare earths are up 75. What's the whole thing that happened on Friday? It's the rare earths. I mean, so again, I'm not that smart, right? I just want to know, I want to protect the purchasing power of my clients' money first. We have a different regime that's coming in, and your portfolios don't reflect that. So this is just, and these are for example purposes. I'm just showing you this. This is a 60-40 portfolio. So to show you that gold's not just a recent, I'm not here trying to pitch gold. I'm just showing you how we manage clients' money. We're looking for opportunity. We want to manage risk. We want to be more precise. And part of it is the fact that if you look at a 60-40 portfolio, the last 10 years up 117%, which isn't bad, with a 20% loss along the way. We call that a drawdown. Meaning, what was the risk I took if I had $1 million? I doubled my money to $2 million, but I had to lose 20% along the way. That's what a drawdown is. That makes sense. That was the pain that I had to get there. So look at the same exact loss for what? 2.5 times the return, right? And I'm just showing you this. Again, I'm not a gold bug. I'm just here to talk to you about the different regime we're in based upon deficits, currency wars, things like that. Looking at gold being part of a reserve currency. I'm just giving you an example how we see the world, right? When gold's we don't like gold, we're going to move on. I care about, they're all widgets to me, right? I don't care about what it's called. I care what it does. So when we're getting into portfolio building, this is kind of our core strategy. So we run 3 different portfolios. You're my client today. We run strategies where we're targeting maximum downside loss. Okay, we bifurcate portfolios from growth portfolios and cash flow portfolios. So these are one of our growth portfolios. There's 3 strategies running in one. We have our risk on, risk off, which think of S&P 500, the market. Okay, remember I told you this part of the portfolio went risk off Friday. Okay, we have 2 other pieces. Our sector rotation. I talked about that a little bit. The 11 sectors of the S&P. The third is our global macro, fancy word for saying commodities, interest rates, currencies, things like that. Again, we want to invest in things that are going higher. We're not trying to be smart guy and prognosticate. These are things that are confirmation that things are going higher. These are the 3 areas, and I'm being a little generic, but I'm just showing you this is very sophisticated, the way that our competitors manage money, the way most of our clients manage their money. And I'll give you kind of an example. This is actually, I had my staff do this for you guys today to show you. So as of Thursday, let's see, go back here. Here we go. As of Thursday, this was the positions Thursday. That was the night, okay? So Thursday, our sector rotation was mostly in semiconductors and technology. And semiconductors, they're up like 50% this year. It's, Qualcomm, it's NVIDIA, Broadcom, Taiwan Semiconductors. And we can own stocks, we can own ETFs. I'm just using broad market segments to make it simple. Okay, I'm not putting ticker symbols up here. So our sector rotation strategy has been in technology and semiconductors, okay? So doing well. Our global macro, 1/3 has been in, and we're fully allocated, in gold and silver. Okay, gold's the third, 41.50. Silver just broke all-time highs today. $50.50. Yeah. So you want to own some assets in here, I'm telling you. Rare earths are up like 80%. Okay, rare earths are a big problem. There's a company called MP. We're buying companies now. We need to be. That's a whole other topic conversation. I know it sounds kind of weird, but we got to protect ourselves. But the point is that most of you have no portfolio anywhere close to what this does, right? Not that mine's better or worse. I'm just telling you how we do things. And you'll see when we do our retirement income plan, I separate assets from cash flow investments to growth assets. I call it buy income, invest the difference. So we're not taking income from this asset. We want to grow, but we're also going to manage the risk. We look at risk management, and we have what's called RMG 10, 15, and 20. What those are, risk managed growth. Most of our clients are RMG 15 series. We're targeting a max loss of 15%. It's not guaranteed. We're modeling, mapping, risk managing to a max drawdown of 15%. The reason that's important is because I've done this for a long time. Anecdotally, I know once you get past about 10%, clients get nervous, right? Our revenue's tied to your assets. I don't like losing money either. I hate losing money. right? Because that doesn't make any sense for a money manager to not care about the loss of client's capital because it directly impacts the bottom line of the firm. Well, if you're a Merrill Lynch or Morgan Stanley, not picking on them, you can add another 1,000 clients next month. I mean, it's a little different story, right? And so my point is that we are going to manage the downside, which is our first job. So what you can see here is that as of Friday or Thursday, this was the portfolio. And this just happened. This is Friday. So it's kind of neat because this just happened. A third of the portfolio went risk off. Now that could be for a week, a day, a month. I don't know, right? But with our strategies, that's what it's telling us, right? So we're still two-thirds invested, but we went from S&P 500 to treasuries. Just like I said, now we're rowing in this part of the portfolio. We're not all out of the market. We're still a third in our sector rotation, which is now went to utilities, healthcare, and technologies. We still own some technology, but it went pretty defensive. Utilities and healthcare, which is not an asset class you want to own when things are doing really, really high. Even though utilities are doing very well this year, because energy with AI is a big, big deal. So utilities are about 20% this year. S&P's up about 13. So utilities are doing very well this year. So they're kind of a sleeper asset. So we just transitioned this last week from semiconductors to utilities, healthcare, and technology. We still have our gold and silver, which is we're fully allocated, and all these are actively managed. So on the gold and silver, if we don't like gold and silver anymore for technical reasons, then we're out, we're in treasuries or whatever else we're in. So I'm just giving you an example of how we're going to manage money in the growth side of the portfolio, right? In a minute, I'm going to show you, let's go to this. I'm going to stop. Any questions on this? I'm not going to take a lot of questions tonight because of time, but I will take some questions on this because I've said a lot on this. Something broad, not too detailed, but if you have a question that's burning, then I'm okay with it. Anybody have a question on believe it or not, we have portfolios that can own crypto, right? Because we look at crypto as a commodity. Now it's not going to be, it's under the commodity umbrella, but we actually have a crypto strategy that we trade that we've been out of crypto for a couple of weeks now. It does pretty well, but it's very actively managed. It's not, we don't buy and hold it, but in our base, it does not get to fit in this portfolio very, very often, quite honestly. Again, we're looking for momentum, so it can fit, but really this is where we're basically half gold, half silver right now in this part of the portfolio. Again, this is just to give you an example, right? I could talk to you a year from now and it'll look completely different. You want that to be, especially if it's your money, right? All we care about is how we protect capital. First, we want to maximize cash flow. We haven't even talked about that yet. Second off, first off, we want to protect capital. Second, we want to maximize income. Third, we want to grow capital. That's a different ordering rules than you currently probably have in your portfolio. We hope it goes up. That's what you're planning, so most people, including your advisor. We want to protect capital first, maximize income, grow capital. Because once I have a solid income plan, I can feel more comfortable with some risk. We're still going to manage the risk. I don't like losing money. Now, again, we're in these portfolios, we're owning securities that can go up and down. So we're going to manage that risk, but we still want our capital to grow. I'm going to move on. So our money management philosophy, we talked a little bit about active money management. We're going to do a lot of tax planning. We're going to give you an example of a very specific issue with real estate in a minute. And then income planning, which we'll talk about in a second here, because the income plan, the retirement blueprint is the foundation to everything. We have to solve for cash flow first, right? We have to solve for cash flow first. Once we do that, then we can do other things with your money, right? And so again, we're going to give a good example of that in a minute. Here's a good case study here. So we got John and Jane, 65 and 74, live in San Diego. Pretty typical client. Have about $2.5 million in savings. They're retiring and they want to know, how much can they spend? They're concerned about market volatility, worried about running out of money. Probably like anybody in this room. These are real people. Protecting the names here, of course. But I'm going to give you, these are spreadsheets I've used. So this is our income plan. So what we do is all of our income plans, I've used these spreadsheets that we've used for 20 years now. I have some books, like I said, they're in one of the books back there. They're actually in there. Real simple, right? We don't use fancy software. We use Monte Carlo simulator. We're trying to produce income, cash flow, right? So this is the income plan. So what you'll see here, so it just goes left to right, gross income, annual, monthly, net income after tax, right? And so actually, guys, that effective tax rate's too high over there. I can tell you already. We have to change that. Yeah, that's probably too high. That's all right. Maybe it's not. Erica's the one in charge. That's all right. Doesn't matter. I think it is though. That's all right. Anyway, is that this client is going to retire in the next 3 years. So we're projecting out Social Security. They have a retirement. They have a rental property, which most of our clients have rental properties. That's the net cash flow after expenses. The average rent, I analyze real estate almost every day. The average net return on equity in San Diego County is about 2.5%. Not very good. Now, you've made millions of dollars in your real estate. It's not a bad thing. My point is, we'll get into this in the next slide in a minute, is that the return on equity is very low right now. So you've already won the game. So unless you want to be a landlord the rest of your life, we may look at other options when we look at our clients. So maybe we wanted to get rid of the real estate. Maybe we want to do an exchange. Maybe we want to sell the real estate outright. The biggest inhibitor for selling real estate is what? Taxes, yeah. So we're going to talk about that, of course, right? Because that's the number one reason people don't sell their real estate. But the rate of return is poor now. You're earning less than a U.S. Treasury bond. And you have all the liability. We call it toilets, trash, tenants, toilets, and trash, right? And so we'll get into that. But all our clients, most of our clients have some type of rental property. In this particular case, our ultimate is the buy income invest the difference. So I had a whiteboard here I draw. But in this case, we had a very conservative client. They wanted all their income to be guaranteed, right? And that doesn't make a difference to me. I'm going to show every client a guaranteed plan and a plan that's not guaranteed. Maybe that has more variability in it. But you get to decide, but at least you know what's possible. I started in the annuity business in 1995. This is not an annuity workshop. Less than 20% of our clients' assets are in annuities, but I know them inside out. There's times and places for them. This client was afraid of their own shadow, right? And they said, David, I want all guaranteed income. So their Social Security is guaranteed. Their rental income is not guaranteed, but that's their comfort with it. And then what we did is we took of their $2.5 million. They wanted the majority guarantee. That's right. This is a different client. So we put 30% of their money in a guaranteed lifetime income annuity. It's paying about 8.5%. Okay, that's pretty good. So think of it like a bond. Would you rather get guaranteed 8.5% distribution rate or a bond that's average 1%, right? Now, the difference is with an income annuity, the negative with an income annuity, because again, I'm a fiduciary, I'm agnostic to it, it's a tool, is that after about 15 or 20 years, there's no money left in the account. Now, you still get paid all your assets, all your income, but we have to look at we will do a beneficiary analysis to look at what's left for the kids. But a lot of times, I mean, this client, you'll see what's left over. It's a lot of money, but they're a useful tool for some clients. This is a kind of buy income invest the difference. We're doing three strategies. We're doing one is the guaranteed annuity. One is what I really like. We use this for many years called our enhanced dividend. Basically, the average dividend yield on the S&P 500 is about 1.5% right now. It's low, right? I've been managing dividend portfolios for many, many years. Ours is about 5%. There's things that we do that when I'm talking to you in person, I can go over with you, but our average yield on our portfolio is around 5%. Okay. That is kind of that's the example I give where we kind of have a rental property in our 401k plan, right? Or IRA, because we're just collecting cash flow. We're not selling assets, just like you have your rental property, right? So that's that strategy. Then these are our risk managed growth strategies. So this is pure growth. These are the strategies that you saw earlier, where these are the sector rotation, the risk on, risk off, the global macro, because we don't need cash flow from there. We solve for income. Part of it's guaranteed. Part of it's predictable, not guaranteed. And part of it is just pure growth. Okay. So that's pretty cool. We have 3 different strategies for one client. Kind of cool. Most people don't have that kind of planning. So they wanted around $10,000 a month. We solve for that. Their money's growing over time, which is great. So I kind of like to go to this slide, the kind of the result side. They had more than enough income. Yes, sir.
I noticed that in the rental column, rent stays pretty much constant.
Yep. Yeah. Because we don't control that. Yeah. The tenant, you do, I don't. Yeah. It depends upon that. That's your choice, not mine. So if I will tell you, because I have a lot of experience with this, most people don't raise their rents very often because they don't want to lose a tenant. Most San Diego landlords their rents are under the current market value. So I don't want to spend a lot of time on this. I'm just telling you. I'm just using what the client told me, right? I'm using what the client tells me. If you have a rental property like that and you're getting $2,000 after expenses a month, that's what we're using. Okay. The rents don't go up with CPI inflation. You're not running to Target or to Walgreens that have rent escalation clauses. I'm telling you, that's just not. Do you own rental property? Yeah. So do you raise your rent every year? Yeah. Well, what if they're there 20 years? Yeah, I understand. I'm teasing. I'm just being real with you. I do this every day. I analyze real estate every day. Most people in this room, your rental income is below market. Period. End of story. If you've had tenants in there for any length of time. Okay. So I'm just using, what's this, sir? Yeah, so he's saying his rent's 30% below market. Yeah. So all I'm saying, I don't want to spend a ton of time on that, but I want to respectfully answer your question. I'm just using if I'm sitting across you, we're doing a plan for you, I'm going to put in your rental income. Now, I'm not even going to raise, if you say, David, I'm going to raise it every 3 years, we'll put in whatever you want, but I'm a conservative. Yeah. So I'm just saying, here's what it is. So yeah, and I appreciate the question, but I'm just telling you the why, right? Does that make sense? And so with their cash flow, going back to this screen, which is what's most important, is they had plenty of income. And we're not even using all their assets. Think about it for cash flow, which is great. Buy income, invest the difference. Remember, I talked about that before. Buy income, invest the difference. In an extreme example, some clients will say, okay, I just want all annuity. It doesn't happen all the time because I want all guaranteed income and the rest we're going to invest in stocks. And that does happen. Okay. But we bought income, invest the difference. They feel very good about their retirement plan, less stress for sure. And they know that they have some of their money's guaranteed. And the nice part, they have 3 kids. Oops. And they're projected to leave about $7.5 million. It's pretty good. Even though one of the assets, the annuity, is going to be gone. Right? Now, they're going to get the income forever. You can run out of, in an income annuity, you can run out of assets, but never out of income. Right? So if you live to 100 and after 20 years, there's no money left, you still get paid. It's like a pension. They're the same thing. Most pensions are actually insured by insurance companies. The liabilities are purchased by an insurance company because the corporation doesn't want the liability. So really, all a pension is an annuity. I analyze pensions all the time. All right. Sometimes we take the pension, sometimes we don't. But the reality is that all we care about is how do we maximize income after tax, and how do we have the safest cash flow possible? And you decide on that. Of course, our firm would be your advisor in that particular case. We're of course going to counsel you. Right. But I'm not going to say, what do you want to do? I'm going to say, here's what I recommend we do and why based on what you've told me. But here's 3 options. Here's the guaranteed option. Here's the semi-guaranteed option. Here's the no guaranteed option. You decide. Right. And it doesn't make a difference to me. Okay. But at least you have talking to somebody that has experience with that. So if you do want that, because clients do, I had a client come to me a couple of years ago. They'd been in cash since 2008. This is the financial crisis because they were so scared of the stock market. So guess what we did? We bought an annuity with half their money because that solved the problem with, I think it was 1.5 million, and the rest we invested in stocks or risk managed growth because they had all the income they needed, but now they felt comfortable because all their cash flow needs were met, but they still could invest in the markets, right? And make money. So the running out of money part, I like to show this because this is a spreadsheet I've used for many years. And we update it every year. And it's real simple. It's just this: will I run out of money? I used to do a workshop called the Hatfields and McCoys, right? And it was basically people getting the same rate of return, but sequence of returns. When did I make what return and when? Because when you're saving money, losing money is not as important because you have time to come back. You're depositing money into your accounts. But this is somebody who's retired. So if we retired in 2000 and we took out 5% of our account, and a lot of people, especially if you have no pension, no rental property, 5% is about average, I'll tell you. Think about that. 5% is about average. So if you have no other sources of income and you have a couple $1 million in your account besides Social Security, it's about 5% cash flow is needed. That's a high number. It's not small. Then we're comfortable with that. 5% is kind of our average for distribution rates for our clients, which is high. But if we're taking out 5%, plus just using 1.5% inflation, if you retired in 2000, you ran out of money in 2020. Why? You still averaged 7.6%. Problem is, look what happened. So as you start losing money here, the market dropped 3 years in a row here. I mean, after here, you're done. You have $500,000 in 2002, game over. And you're taking out $50,000 a year. Now that's 10% of your capital, is it not? It was 5% when you started, now it's 10%. Done. Game over. So you're either going to run out of money or you have to do something different. But this is reality. This is reality. If we were going back in time at 2000, this is what you would face, theoretically, right? And how are you dealing with that with your portfolio? Even a 60-40 portfolio, which is going to be less aggressive, we're still spending down capital pretty aggressively, right? We still, in this example, in 2024, have a $400,000 left. But I don't know about you, but we don't have any clients that we're like white knuckling going, oh my God, we retired 10 years and now I had 3 million, now I got 1.5. That's insane. That's called stress. I don't do stress. If we have that problem, you might as well buy an annuity for some of it, right? If you're going to run out of money anywhere or spend all your assets, you might as well buy something that's guaranteed. Would you not agree with that? If you knew this ahead of time, wouldn't annuity look really, really awesome? Yeah. I started the annuity business in 1995. That's why I can talk about this. I lost no money in 2000, the 2000s. I was 100% fixed index annuities. I wasn't smart. That's what I did. It wasn't like I was a genius. I was lucky. And in 2008, I was about half annuities, half money management. So we were half smart, half not, right? And so the point is they're a tool for people. And I just like to teach people when I'm doing my retirement planning second opinions, which we'll talk about in a minute. I like to show people that for your own benefit. Doesn't matter to me. You want that way or you want it this way. We're comfortable either way. Oops. Oh, my glasses were bad there. I can't see. There we go. Let's see. This is crazy. I had my staff put the slide again. I didn't realize it was this good. So this is a little old. So this is a fixed index annuity that is giving us 58% of the S&P 500. I've used these companies forever. Remember, I've been in this business a long time. A+ rated company, great. So mark goes up 10, you get 5.8. Mark goes up 20, you get 12 or 13. Mark goes down 20, you get 0. Right? So here's those three. The first 3 years you're retired, let's just say you had some money in this fixed index annuity, right? You didn't make any money. Now your account's going down because you're taking out. It's the same math as the other accounts, right? It's 5% distribution rate plus inflation of 1.5 or increases. But the point is, I think in year 3 with the stock market, you had $400,000 left, right? Cool part is, as of today, you'd have 1.5 million. Started out with $1 million. It's pretty cool. So it just shows that's why I'm a risk manager. So we don't need annuities to manage risk. They're a tool. We use other means to manage risk within our stock portfolios, but I come from this business, right? I come from the annuity side of the business, so I appreciate risk mitigation. Just letting you know. Plus, my grandfather died dead broke my first year in the business because he lost all his assets to long-term care. So my first year in the business, 27 years old. Was it 27? Yeah, I think I was 27. Yeah, it's 27. 27. And I get a nice phone call from my mother crying on the phone saying, David, we have to sell the house. We have a foreclosure notice for your grandpa's house in Fresno. Because guess what? I don't know if you experience this or not, but it's called recapture. So recapture basically means a recovery. So where they can go in, if you qualify for Medi-Cal, you're one of your family members or siblings, and my grandfather used up all of his assets, and then he spent $20,000 of the government's money, and they put a lien on the house in Fresno, $50,000 house at the time, for $20,000, right? So my point is that we want to be able to be in a position, because most of our expenses, even if we had on that 60-40 portfolio, that we still have $400,000. The problem is that end of life cost is so expensive right now, and we can't really solve for. All we can do is do a good job of managing your money, because the cost of care, of long-term care insurance, is ridiculous. Probably in the 2000s, more than half of my clients all had policies, all of them. But now it's like 1 in 20 or 30. It's just astronomical. So what you have to do is be a good steward of your money. Right now, the average cost of memory care in San Diego is $10,000 a month. It goes up 5% a year. Right? It doubles every 15 years. So the average age is 84 for long-term care. The average is 3 years. So the average cost for you in 15 years from now is going to, if you're talking $250,000 a year, it's stupid. So it's real though. So, and I know from experience. So my point is, the only way we can do is be really good stewards with your money. That's the only way we can really do that. It's not go through these massive losses of 30, 40, 50%. But I want to show you one more thing on this one. So this just as a comparison of showing the annuity. And again, we're not here to talk about annuities. I just ran these numbers. I'm like, this is pretty cool. The moderate 60-40 in the stock market, 1.5 million, 400,000 ran out of money. So my point is for some of you, either a fixed index annuity or fixed annuity or an income annuity may be appropriate. That's the only reason I'm bringing this up, just so you understand it. And we use it very judiciously, right? You drive the train, not us. I don't want to get into that. Where am I at, guys? Time-wise, am I good or not? No, I'm not good? Okay, I got to go. All right. Game over. All right, now here we go. So I do want to talk about real estate. I promised you. Okay, we're almost done. Bear with me. So we do this kind of analysis all the time. So these clients are 60, 64 years old. They bought the property, what, 500,000? Yep. Current market value. Everybody in this room has property like this, right? 1.7 million. The rental income was $4,200 a month, 50,000 a year. Guess what the average rate of return on the equity was? About 2.8%. Let's take 50,000 divided by 1.7 million. It's 2.8, 2.9%. What I'm telling you, it's just what it is. This is a real client. We're just helping this client right now. The estimated capital gain if they want to sell the property is 1.2 million. right? That's the capital gain. Now the tax on that will be about $400,000, but the gain's 1.2 million. So they were never going to sell. And they didn't want to do a 1031 exchange. They didn't want to deal with real estate anymore. They just didn't. And this is very common. One of the benefits I have in doing this for so long is I get to kind of see around the corner a little bit, kind of what's happening. And a lot of clients are now looking at getting rid of their real estate. They've made all the money. I had a client 2 years ago. They had like $4 million real estate that we sold, did some strategies with them, saved them. I think it was like $1 million in tax, but they had like $300,000 of deferred maintenance. So they're like, I don't want to do that. So the problem is that what I call, let me go back here. Oh, we don't have it on there. That's all right. Oh, the tenants, toilets, and trash. There it is. So in this example, what we did is we put a plan together for them that was a 1031 alternative. So instead of the money going into another piece of real estate, so remember I told you we have two divisions of our company. The ultra high net worth side, where we deal with our tax attorneys, CPAs, other advisors. Again, as a client of Reyes, you can work with our CPAs and attorneys as well. But the tax attorney side is where we get involved with some very sophisticated strategies we use for a long time. And this one is where we can use, think of a 1031, except your money, we custody with Charles Schwab. So instead of your money being in a real estate property, it's at Charles Schwab. But we get the same benefits of the tax deferral of the 1031, the sense where we're not paying the taxes today, right? So in this particular case, they would have paid $440,000 of tax. They paid no tax, right? They have more liquidity. They have more investment flexibility. They have more control of the assets. And we don't have what I like to call the tenants, toilets, and trash. Yes, sir.
Moving the example of this is on the third.
I am giving you an example. That's why I'm giving you the example of what happened. That's what I'm taking you through.
1031, you exchange for like.
Correct. This is not a 1031. This is where we're using strategy we use for our clients, that we use certain trusts and other documents with our tax attorneys and CPAs and trust attorneys, that we're actually creating a liquidity event to where we're selling the asset and we're out of real estate game. So no more tenants, toilets, and trash. Okay. So again, if you come to my office and we go through this stuff, I'll explain it to you. These are very high level strategies. Okay. I'm just telling you the results of them, right? Everybody, if you own real estate, you probably know what a 1031 exchange is. Think of the same concept. I'm not paying taxes today. I'm deferring taxes. But instead of owning real estate and having deferred maintenance, having homeowners insurance, property taxes, I now have an asset that I'm not earning 2 or 3%, and I can earn whatever rate of return that we want to earn on that relative to the risk we want to take. So it's just a freedom. Again, I've been in the real estate business for a long time relative to investing and disposition of real estate. So I'm just sharing with you strategies, giving you an example of the outcome. I don't have, if you want to sit here for 4 hours and go through the strategy, it's not going to happen. But I'm showing you the result of what can happen, right? I'm a fiduciary. I get this every day. I thought it was a radio show. We can do this right now. But the reality is there's a lot of people in this room and a lot of our clients that go through this process because they don't want to own real estate. We have clients right now that we're doing the same strategy for. So the bottom line is this client went from a $50,000, $1.7 million property, earning less than 3% on their money, have all the tenants, toilets, and trash problems. They have all the issues that come with real estate. Now we're going to get them just at a 5% distribution rate, the 5% yield on their money. We're going to get $85,000 worth of income. So we're almost doubling their cash flow. We're not paying the taxes today. We have no more liability, meaning that we don't have the tenants of liability. We don't have those types of issues. We don't have the deferred maintenance issue that you're going to have with real estate. And so again, as a firm doing this for a long time, we're just seeing where the puck is going. Wayne Gretzky says, they asked him why he's such a great skater. He goes, well, I'm skating where the puck's going, not where it's been. I'm just showing you where the puck's going. This is what we're doing for clients right now. Right? Yes, sir.
Just in a nutshell, what's the downside of the deferred, or the 1031 deferred? You ought to pay the taxes eventually. Is it?
What's the disadvantage of the 1031 exchange? Just you own real estate, right? And so we have a lot of real estate investments. I'll just tell you, and again, if I was talking to you personally, I would tell you this. I'll share with you now. I'm an open book. Is that real estate values are going down? Okay, they're going down. Right? They're not going higher right now. Okay, when rates are 7%, when commercial lending's in the high single digits, low double digits, property values are falling. We have real estate investment clients. The only reason they're making money on those right now is because their income's so good, right? So my point is that the 1031's fine. Now, I'm not saying that's the devil. I'm just telling there's other things that we can do. So we'll look at a 1031 exchange. You can do that on your own. I'm just going to show you other options that you can look at that can free up your capital if you don't want to be in the real estate business anymore. Because the rate, it's not free lunch anymore. Rates aren't zero, right? So it's not, you've already won this, that you guys already won. So the question would be why? Forget about the strategy. I'm saying if you could sell your real estate, and I'm not trying to tell you to do that. These are people that say, David, I don't want to sell my real estate. I'm not going to convince you to do that. But if you wanted to do that, it's a great opportunity to get out of real estate and not have to pay the tax today, right? And then free up your assets so you get rid of the liability, the cost, the taxes. There's an expense to that.
When is
Right.
the tax due on something like that? 1 year?
We do. The only thing I will share with you on it is sometimes there's it can be an installment contract in there. Is what I'll give you an example of, because these things we do all the time. So you can kind of create. It's kind of like an installment contract to yourself. I'll share that with you. Right. So it's a note that, and I don't want to get into all that right now. Not to not tell you. If you're sitting across from me, I'll tell you everything you want to know. So, but yes, the government's happy to get the taxes. So you just have more flexibility this way, and you're not beholden to own real estate. So again, for clients that are looking to sell their property, it's usually when they lose a tenant and they say, David, okay, now's the time, because I planned to see with them 3 years ago. And they said, well, David, let's go over that strategy, looking at 1031, but what else can we do? It's usually when there's some event and usually a tenant that's leaving. But I bring this up just kind of as a bonus, and because it is something that we're doing a lot more of right now. And so I thought it'd be worth, remember, I'm talking to you as if you're at my office. This is what we would talk about, but we'll get way more in the weeds. We'll go through second opinion in a minute. Julie, come on up here. We'll go through a second opinion in a minute, but because I want to wrap up, but, we have a 3-meeting process at a minimum we go through with you. Okay. So this is serious stuff. And Julie will kind of explain more to you on this, but our second opinions, kind of our tagline, one of our taglines is, you get a second opinion of your health, why not your wealth? And I built our company on second opinion. So it's complimentary. We don't charge you to do it. We take you through all the stuff we're talking about. We're going to do a retirement income plan for you. I'm going to look at your investments. I'm going to compare, here's how you're doing. Here's the risk. Here's your return. Here's the cash flow you're producing right now. Here's how we would do it. I call it the Pepsi challenge. Right? So we don't charge you to do it. Now, the reason we go through this with clients is not because I'm so kind. I used to charge up to $5,000 to do a plan, but the reality is I found it gives us a lot of time to spend together with my team, and we get to see if it's a fit. Is it a fit personality wise, which is really important? Is it a fit? Do you believe philosophically in what we're doing? Right? Okay. So that's what our offering is, and Julie will go through that. But I'm way over, I know, and I apologize. But I'll leave that up there. But that's what we're offering to you tonight, is a complimentary second opinion. So again, through my radio show, TV show, it's what we offer. You're in this group, and we're offering the same thing to you. I highly recommend, if you have interest, you take advantage of it. Again, I've never had a client not enjoy the process. As in, you spend your time and spend our time, right? And I enjoy doing it. It's fun for me. It just is. You can tell I'm a kind of energetic guy, passionate guy. I care a lot. Doesn't mean we're going to work together, but if you want to spend your time and get to know me better and our team, I promise you'll learn stuff you had no idea. Okay. So I'll let Julie finish up, but thank you guys for coming. Okay. Thank you very much.